Qualcomm is down by 22.79% over the past 6 months. Now the interesting thing is that compared to its peers such as Broadcom or Advanced Micro Devices, it is trading very fairly compared to its earnings, currently trading at around 18 times its earnings. Now when we have a look at Broadcom, for example, although it has been growing extraordinarily well, its PE ratio has been pushed up tremendously, sitting at 180, and that is the same case with AMD, whose PE ratio is currently sitting at 112. So what you have to understand is that even though Qualcomm didn't jump up in price like Broadcom, the reason for that is that it is not overhyped and currently seems to be trading fairly or even undervalued. So jumping to our stock valuation spreadsheets, let's plug in Qualcomm's ticker and wait for the metrics to show up. Now, as always, if you find these spreadsheets helpful and interesting, you can always download them in the link in the description. Now, right away, we can see that Qualcomm has a very juicy dividend yield of 2.12%, which is above the sector average. They also have a very low trailing free cash flow payout ratio, which I love about the company, as it means that they can direct a lot of their free cash flow into innovation, share buybacks, paying down debt and increasing that dividend, which is extremely important if you want to cultivate the dividend snowball effect in your portfolio. Now let's jump straight to the 9-pillar analysis, and we can see that the company gets a rating of 9 out of 9. So everything is sitting in the green as we like to see. So first let's jump to the 5-year PE ratio, which we have already talked about. We can see that on average over the past 5 years, it is sitting at 15.13. So if we zoom into pillar 1, we can see that indeed it hasn't been moving up or down over the past 5 years, and currently it is sitting only slightly higher than the 5-year average, but still sitting in the range we would like it to be in. Now let's also have a look at the price to free cash flow, which I find more important than the price to earnings, as the free cash flow is essentially the blood of the company, as it is used for everything such as share buybacks, paying down debt, increasing and paying out a dividend. And we can see that the price to free cash flow is as well sitting at a very low value of only 16.25, again in the range we want it to be in. So compared to the overvalued tech market, Qualcomm seems to be nicely undervalued. Now let's also have a look at the growth of the company. We can see that they have been growing their revenue at a rate of about 13% yearly over the past 5 years. Their free cash flow has been growing very well as well at a rate of 33% yearly, and their net income has been growing at a rate of 28% yearly. Now if we zoom in onto the growth, first moving to the revenue, we can see that indeed it has grown from 23.5 billion in 2020 to 38.9 billion in 2024. Now regarding the net income, that has also grown very well from 5.1 billion in 2020 to 10.1 billion in 2024. That's about a 100% increase in 5 years. Now what you should always consider is comparing the net income of a company to its free cash flow, and we can see that Qualcomm's free cash flow is actually sitting about 1 billion higher than its net income. And we can also see that the free cash flow has been growing at a higher rate than the net income, and that is something I very much love about Qualcomm. As I already said, the free cash flow is essentially the blood of the company, and it is used for everything, unlike the net income, which is essentially just a measuring metric. So what you are seeing right now is a company that has been growing their profits very well over the past 5 years, but they have been keeping their PE ratio and their price to free cash flow ratios nice and low, not going into the overvalued sector. Now the one thing I don't really like about Qualcomm is that their 5-year profit margin has been decreasing over the past 5 years. It is sitting nice and high at 57.59%, but if we zoom into pillar 6, we can see that it has decreased from 60% in 2020 to 56% in 2024. And that means that the company will be generating less net income compared to the revenue, which obviously isn't a great thing, but the profit margin is still nice and high, above the sector profit margin, so I'm not too worried. Something I also like about Qualcomm is that they have been decreasing their shares outstanding at a rate of about 0.33%, which is always great to see, and their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 0.74, which means that with the free cash flow they currently generate, they would be able to pay off all their long-term liabilities in about 4 years. So if the company was to get in trouble because of a lawsuit, for example, their debt wouldn't put much pressure on them and on the investors. We can see that currently they only have about $18.2 billion in long-term liabilities, and they have been lowering them at a rate of about 1.77% yearly over the past 5 years. Now, something I already mentioned is Qualcomm's lovely consecutive dividend growth, sitting at an average of 5.42% yearly. So if we zoom into Pillar 8, we can see that Qualcomm's dividend growth is sitting higher than the year-over-year average company's dividend growth. They also have a very high dividend yield, sitting at 2.12%, higher than the average stock dividend yield and much higher than the sector average dividend yield. And as we know, their 5-year free cash flow payout ratio is sitting nice and low at 35.79%, so their dividends aren't in danger at all. So now that we have gone through the 9-pillar analysis for Qualcomm, let's calculate their intrinsic value and figure out if the company is a buy right now. So for the high earnings per share growth estimate, I plugged in 20%, medium I plugged in at 15%, and low I plugged in at 8%. I then averaged this out with the analyst projections and got a 5-year earnings growth estimate at 8.78% yearly over the next 5 years. Now plugging in the 5-year EPS, the base PE, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, which take into account is currently quite higher than the short-term average. We combine everything, put it in the grams formula, and get an intrinsic value of $165.48, which is 3% higher than the current trading price. Now for the second valuation model, we will look to the discounted cash flow model, and here we plug in the free cash flow of the company over the past 5 years, and using the same method as in the grams formula, I calculate the future growth rate of 9.3% into the next 8-year plus. I then use this to calculate the future free cash flow, and plugging in a discount rate at 8.9%, I calculate the present value of that future free cash flow. I then sum all of that up, add cash and cash equivalents, and subtract total debt to get an equity value, which I divide by the shares outstanding and get an intrinsic value a lot higher than the current trading price, sitting at $277. Now for the third valuation, I want to compare Qualcomm to 3 of its competitors: Applied Materials, Micron Technology, and Lam Research. I took these companies' current stock prices, divided by their earnings per share, and got their PE ratios. And as we can already see, these 3 companies' PE ratios are sitting much higher than the PE ratio of Qualcomm. So when we average them out and multiply by the current earnings per share of Qualcomm, we get an intrinsic value of $224.84. So Qualcomm is indeed undervalued compared to its competitors. And now moving to the final valuation model, the dividend discount model, we take the dividend payouts over the past 5 years and calculate an average growth rate sitting at 6.77%. Now I project the growth rate slightly higher, sitting at 7%, and plugging in a discount rate, we get an intrinsic value of $182.46, again higher than the current trading price by about $22. And finally, moving to the ultimate valuation, where we average out all the 4 valuation models and get an intrinsic value of $212.45, which is 32.35% higher than the current trading price, and with a margin of safety of 20%, we get an acceptable buy price at $169.96. Now, to be fully transparent, I do currently own Qualcomm in my portfolio. I am down by about 5% as I did add it about a month ago, but I will be holding it into the next few years as I really do believe that Qualcomm has a bright future. And with that, I hope that you enjoyed the video. Let me know down in the comments if you are buying, holding, or selling Qualcomm, and make sure to leave a like and subscribe as it really helps me out.